When you're searching for gaps, there's a number of different ways to do it. You can use down touches, like Trend Red down touches the pink line, or you can run the scans on that or any other line. And you can also look in the radar screen under the MFR22 indicators. That's market force recognition indicators, if you're not familiar with the term. And the ability to see those or find those gaps is not that difficult. The difficult part about it is in the proximity group, because you can find a number of identical indicators real easily. You can find down touches or up touches in the trend chart real easily. And those two methods will give you an ample supply of opportunities to analyze. And there are more. But often the tough part about identifying a gap is within the proximity group patterns. And we're talking specifically about the Power 4. That's the pink, blue, white, and yellow. Sometimes the yellow runs by itself like it's under Power Orange, and the other three are above Power Orange. And we refer to those other three, the pink, blue, and white, as the Power 3. And then you have the normal Power 4. You have Zion with it, and we call that the Power 5. And then if you have red also incorporated into the formula, you have the Power 6. So I've mentioned this a few times on a few other videos, but I just wanted to make you aware of that, just for understanding when I refer to those terms on videos or in text. And so the difficult part in the proximity group is simply the variety of possible conditions that are also part of a gap or give us a gap. And we can talk about the divergence. We can talk about the differences in location, where the Power 4 is and the Zion line is, under or over the Power Orange. Remember, in the price or in the power lines, the power chart, when it crosses over zero, it goes into a positive or a uptrend position, if you will. When it's traveling over zero, especially power red, it has a tendency to go up. The price has a tendency to go up. When it's traveling under zero, it has a tendency to go down. All this is true with all of the power lines. When they're above zero, their things are moving up. Under zero, things, because those indicator lines are position indicators. Where they're located dictates the tendency of the price to move in that specific direction. Over zero then is the price issue, and over or under Power Orange is the divergent relationship issue. And so those two distinctions need to be kept in mind, because Zion can be gaps work real well when Power Zion is under Power Orange and the Power 4 are above Power Orange. So in other words, they're divergent. The other type of divergence is the power 4 lines are all up and the power Zion line is down. That's directional divergence. And you can have, when you have both of those at the same time, you usually get a nice gap. And this particular, I'm going to flip over to the charts. This particular gap, our gap is a gap up, and it's in AKBA, and it's April 25, 2017 that it occurred. And in this particular case, we have what sometimes I refer to, if you're not familiar with it, to find a gap, you have to have the conditions that occur within 3 patterns. I'm talking specifically at the moment for a gap up. Those 3 patterns are to have identical indicators. Like, for example, there's 22 market force recognition indicators, and we need a majority. 12 of those typically is what we see. In just as long as I'm on that subject, in this case right here, we have 11 2-day BOC patterns and 7 right leg W patterns. So we have a total of 18 patterns. And this is basically a 2-pattern gap situation as we identify it from the perspective of the identical indicators. I've seen gaps go down as low as 7 and 7 and 7. Meaning they were in 3 specific patterns, 7 in each pattern. Like one was a right leg W, the other one was a bottlenose, and the other one. So you can go lower, but the general rule is to have a majority. We definitely want to see the total count above 12. So in other words, 12 out of 22 is a majority, and so you should have 12 identical indicators, but they can be in 2 patterns or even 3 patterns. But that's the general rule for the identical indicator portion of the situation. The other rule is that you have to have a down touch in the trend chart. In the case of a gap up, you have to have a down touch. In the case of a gap down, then you have to have an up touch. Now, the only exception to that is what we refer to as the sky touch, or trend red and green and gray are, instead of down touching one of the yellow, pink, blue line or the 0 line or underneath the 0 line, instead of down touching those, they go up 3 days, or in this case here, it's a bottom of cycle 2-day up pattern. So it's a down, up, up pattern. And there are 3 days up patterns in which we refer to trend red and green as a sky touch. In other words, they do not down touch something like, because I've identified the vast majority of gaps require a trend red, green, or gray in a down touch format. In this particular case right here, we can see that the trend gray is going down. It's in a right leg W higher pattern, and it's down touching the pink. Gray is at 5.2, pink is at 3.6, blue is at 5.47. So it's technically down touching the pink trend pink line, which is which is the best line to down touch, causes the most reaction because it's under the blue but above the pink. And so this actually has a down touch to it, but I want to make you aware of what we refer to as the sky touch, and that's red and green going up at least 2 days. In this case it's 2, other times you'll see it as 3 days up. Excuse me. But the difference is, or what usually happens is that the trend red is in a low angle up. If I go down like this, then you can see it more effectively. But it's in a low angle up. And please note too that trend red's at 22 and trend green is at 13. So that gives us a 9-point spread, and that's a pretty strong spread difference between those two, which is basically, and it accentuates the probability of the gap. In this case here, this gap was a little over $2.50 from the previous close to the open. It then went down and then went up. You can see probably another 75 cents by the end of the day. It went up a lot higher during the day, but ended up as a shorter green body candle the following day. In your power chart, you had the same thing. You had a BOC 2-day up pattern. Note how high the pink and blue lines are in relation to what you see over here 4, 5, 6 days before that. All of your other lines are basically under zero. And remember my comments about the power lines. When they're under zero, they have a tendency to go down. When you're over zero, you have a tendency to go up. And you can see that they're significantly higher. And in this case here, we have the power 4 in a 2-day up, all of them at low angles up, which form a bottlenose the following day, and power Zion is down touching the power green line. And so we've got a directional divergence between power Zion and the power 4, and that's one of the things that we really like to see in the form of divergence between the power 4 and the Zion line. That just invariably helps the gap up situation. We also, if we go over here to the price chart, you can see that price green is at 136, and the price red is at 130. Again, if you haven't, or if you're not familiar with it, I've indicated that you should look at, one of the oftentimes visible signals of a gap up is when the price green and red are both above 110, and we love it to see it when it's above 120, and in this case here we have that. We also like to see zip green at 100, and of course here now we have zip pink that's climbing up, and it's right under zip green. The other thing I'll point out right now is swing Zion is highest, and that's in a low angle up. This is the position that you see swing Zion in just a huge number of times. A high percentage of times swing Zion will be highest, and it will be in a low angle up as highest, because the next day it obviously forms a bottlenose. Also, a contributing factor or supporting evidence in this situation is zip red is down touching the 50 line. Zip red is at 56 in this case. And if you've heard me comment, I generally like to see the zip line touching the 50 within 5 points. This one's one above that, so it really qualifies in my mind as a down touch 50 line. The other thing that you will see, I guess I'll comment on, is that the majority of the time you'll see, or not majority, how do I say this? You will, as supporting evidence, you will often see power red highest. And as you can see here, the day before the vertical green line, which is the day before the gap, so 2 days before the gap, the power red crossed over zero, and that's a real good signal. Keep in mind, look at it down in here. The power red is continually under zero. In fact, it's under the power orange line, and your other lines, your power 4 lines and Zion, are right near zero or always under zero for many days in here. And so hence, look at you obviously see hardly any price increase of activity in these last 10 days before the gap. The one I do like to show opposing evidence. You sometimes get it, you sometimes don't. The opposing evidence that it sticks out for me is right here in the zip green chart. Remember the rule for the pink green top. That's zip green at 100, pink green is right next to it, underneath it, and it's climbing. It's going up. And that qualifies right there as a pink green top that could potentially go down the next day. That's it has, however, it was not that day and not the day before, but the day before that it was buried underneath the other zip lines. So the key thing here, again, I'm not sure which videos you've seen, but what we do when we're looking at the pink green top, that's with zip at 100, zip green at 100, and zip pink climbing up higher and higher and higher before the drop takes place. We look at the zip Zion line and we watch to see the zip Zion line if it's continually going up. As in this case here, if we go back here just about 5 days, right there, well, right back here, zip Zion is almost lowest. There's actually zip gray is in its way. So it's almost lowest way back here. And we don't count, when we're analyzing zip Zion, we exclude zip green because both of them track trades in and out of the stock. And so we exclude that when we're looking for lowest or highest indicator line. And so on this day here, it would be, it looks like it's about 4 days before the day before the gap. Zip Zion is lowest. It actually went down one more day, and then from the last 3 days it started climbing up. And so we would not think that the price is going down on this day from the perspective of how the pink green top looks. We would anticipate it continuing because of the zip Zion line. I mean, if we just looked at the zip Zion chart, obviously we have a lot of other information that tells us it's probably going to continue up. But I just wanted to make you aware of that as a part of just exclusively looking at the zip chart. So in essence, we have a number of contributing factors inside of this equation. The trend red and green are in what we have typically been calling this the sky touch, which basically means red and green do not touch anything like it normally would be in a down touch situation. Excuse me. But we do have the gray that has technically down touched this particular situation. And so it does qualify, especially when gray touches trend pink, it qualifies as a down touch, which then gives us, with our 11 two-day BOC patterns and 7 right leg W patterns, we have 18 patterns, 18 identical indicators that qualify as a 2-pattern scenario. And 18 out of 22 is pretty darn good. That should potentially drive us to a gap. But we obviously can see the power chart. All your power 4 are all up and Zion is down. A lot of times you'll get that mixed. The pink and blue will be up, the white and yellow will be down, and Zion will be doing one of those two. And that will still gap. There's a number of formulas, and the best way for you to see the proximity gaps or excuse me, the proximity patterns within the Power 5 is to just simply look at these videos, and you'll begin to see how the patterns come together, and you'll begin to see what works and why it works. You might have a really odd pattern in the power chart, and then you have the sky touch in the trend red and green. Real good chance that you're going to get a gap. And then, of course, if you only had 12 identical indicators versus 18 identical indicators, you would probably have a gap that is going to gap half of what it gapped, what this one gapped on this day. It's all relative to the number or to the amount of supporting evidence that you see inside of each of these opportunities. It just the more you get, the more power the reversal seems to have. Or excuse me, it may not be a reversal, it may just be a gap, like in this case here. But it's definitely powerful, and the setup is real easy to see. Please note that your yellow, pink, and blue in the trend, that's your trio, that's above zero. Your green and orange are both up, but they're slightly under zero. Green and orange here are 0.034 and 0.080, so that's 0.046 apart. They're real close together. On other videos, you've heard me talk about how they, oftentimes the closer they are, the better they are. We establish 0.15 as a maximum, but there are exceptions, especially on days when you have 3 up pattern. On days like that, the separation will be much bigger, and that's fine. But this is the basics on on this particular pattern. I wanted to continue enlightening you in the pattern particulars, as well as the as keeping an eye on the divergent issues, because Power Zion has directional divergence and the Power Orange line divergence, with Zion under, Power 4 lines over. Also, while I'm at it, when you get a situation with 3 days down, sometimes you'll have the Zion, the blue, and the white all underneath the Power Orange line, and and 2 of them will be up above the Power Orange line. Those still work as a gap. There's just a lot of examples, and that's why the important part of understanding how to identify the 3 patterns and their conditions falls within the proximity group. The other 2 are real easy to see. Your down touches or your identical indicator counts, those are real easy to figure out. But it takes a bit to grab a hold of and see what these things are doing in the proximity group patterns. So that's the place to concentrate your efforts on if you're searching for gaps. And the other thing too, when the less supporting evidence that you have, then what ends up happening is you find the start of an uptrend. And so you get, 2, 3, 5 days up, which is nothing wrong with that when you find those. So it's an amazing system. You've heard me say it before, but we find gaps before the gap occurs.